One feature of 2020 is a disconnect between stock market performance and the hit experienced by the global economy. Despite the COVID-19 pandemic denting GDP in almost every country around the world, major stock market indices are flirting with record highs. Yesterday in the United States, President Donald Trump withdrew his threats to obstruct a $2.3 trillion government spending and coronavirus relief package, sending global stock markets to even higher levels. Markets were also helped higher during their first post-Christmas trading session by the news on Christmas Eve that the United Kingdom and European Union have agreed on a Brexit trade deal. The relief experienced by investors following this news pushed US stock indices to intra-day record highs, and the DAX index in Germany reached its highest ever level. But can these record stock market levels be sustained against a backdrop of economic uncertainty and rising levels of government indebtedness? By the end of this video, I'm going to reveal the factors pushing stock markets to record highs and also answer that all-important question: can they keep on going like this? Hi everyone, I'm Martin Bamford, a chartered financial planner at Informed Choice. On this channel, I talk about personal finance, investing, and happiness. I make these videos to help you become wealthier and happier. If that sounds like a great result, please click on that little red subscribe button to become a part of our subscriber community. It's completely free and you'll never miss an episode. It's been a strong start to the week for global stock markets, with traders returning from their Christmas break to a couple of good news stories. First was the announcement on Christmas Eve that the UK and EU have agreed to a trade deal coming into force when the Brexit transition period ends on the 1st of January. We often talk about good news like this being priced into the markets, but on this occasion I honestly don't believe that the markets were convinced. At best, there was a 50-50 chance of a no-deal Brexit, with the UK and EU reverting to World Trade Organization trading terms with all of the associated tariffs and custom checks. The trade deal is awaiting UK parliamentary approval on Wednesday, with a very minor risk of failing to secure enough votes from MPs. The European Parliament won't vote until the new year, but ambassadors for the European Union's 27 member states have unanimously approved the provisional application of the trade deal. So good news on the trade deal driving markets higher, as well as Trump stepping aside and belatedly agreeing to sign off on the $900 billion worth of COVID relief and the $1.4 trillion worth of government spending. The COVID relief and government spending bill takes the US through until the end of next September and was at risk of delay after Trump wanted the level of spending scaled back, but increasing the level of household support from $600 to $2,000 per person. He is an old chap, isn't he? If Trump had stuck to his guns, it would have resulted in a shutdown in parts of the state infrastructure and a continued freeze for unemployment benefits for millions of people. I think there is one other good news story that helped to push markets to record highs at the start of this week, and that's the pending approval of the Oxford AstraZeneca vaccine. Pascal Soriot, who is chief executive of AstraZeneca, speaking to the Sunday Times, said, "We think we have figured out the winning formula and how to get efficacy that, after 2 doses, is up there with everybody else." That statement suggests the efficacy of around 95%, and it's also apparently 100% effective in preventing severe illness requiring hospital treatment. The Oxford AstraZeneca jab is great news for several reasons. It's cheap at around £3 a dose. It doesn't need the same ultra-cold storage required by the Pfizer-BioNTech vaccine, and the UK government has already placed an order for 100 million doses. This vaccine, along with the others which are already in use, could quickly unlock the UK economy and get things back to some sort of normal. It's little surprise that the markets are responding positively to that news. Of course, the Brexit trade deal, Trump allowing stimulus through, and the AstraZeneca vaccine news is all short-term news. It's good news for the markets this week, but it's not necessarily what's pushing them to their record highs. To find the answer to that puzzle, we need to look at low interest rates. Interest rates are incredibly low right now because central banks are printing money to buy up stocks of government bonds, a process known as quantitative easing, or QE. This massive money printing process drives up the prices of bonds, which is government debt, and bond prices have got an inverse relationship with bond yields. So higher bond prices mean lower bond yields and therefore lower interest rates. But what do low interest rates have to do with high stock market valuations, high stock market levels? Equity valuations get a hefty boost when interest rates are so low because these low interest rates are used to discount back future profits. QE is also pushing up the supply of money. Some of that extra cash has found a home in the stock market. Looking back at history, when money supply increases, so does the level of the stock market. They fairly reliably move in tandem with each other. But I hear you say, how can the stock market race ahead when the global economy is doing so badly? And that is a fair question. COVID has hit the economy hard. Here in the UK, but also across Europe and in the United States. Unemployment levels are high and they are rising. Unemployment in the UK is forecast to reach 2.6 million people by the middle of next year. That's 7.5% of the working age population. More people out of work means fewer people buying goods and services, and you would reasonably expect company profits to fall accordingly. What we need to remember here, as departed from logic as it seems, is that the economy and stock markets are rarely well correlated. Looking back to the end of the Second World War, stock markets rose in 7 of the past 12 economic recessions, rising on average by 5.7% during those times. There's no guarantee that markets will continue to rise in the next year or two. Over the long term, we would expect stock markets to reward patient investors. In the short term, volatility and market corrections are a feature, not a bug, of stock markets. Corrections happen, and when they happen, recoveries typically follow quickly. Investors who lose out when stock markets fall sharply are those that panic and take their chips off the table at the wrong time. I do have concerns about longer-term structural issues surrounding the end of QE and its ultimate reversal. There are big questions for central banks, governments and economists to answer about how that pans out and the impact it has for investors. But that is quite frankly a tomorrow problem. Another concern that plays on my mind an awful lot as somebody who is responsible for allocating £500 million of investor capital. £500 million sounds a lot better than £500 million, doesn't it? And that concern is the concentration of stock market value in a relatively small number of companies, a relatively small number of sectors. There is a problem, I believe, when the value of one stock, Apple, exceeds the total market capitalisation of the entire FTSE 100 index of leading UK company shares. There's also a problem when the 5 largest tech companies in the S&P 500 index represent around a quarter of its market capitalisation. Each time in the past that a single sector has represented more than a fifth of the S&P 500, it has ended badly. Energy in the early 80s, tech in the late 90s, and financials in the mid-2000s. We would be crazy if we failed to learn the lessons from history. As an investor, it is always far too easy to convince ourselves that somehow this time it might be different. I know I bang on all of the time about the importance of diversification, but never in my 20-year career in financial planning has that been more important than I believe it is today. Concentrating your portfolio in a handful of sectors or stocks, whether that's intentional or not, is a mistake that will ultimately punish you as an investor. Markets can keep rising in 2021. They don't necessarily need an early and significant economic unlocking event for that to happen. In fact, lockdown measures could continue throughout most of next year, and the markets could independently rise at the same time. I'm not suggesting that's what's going to happen. I don't have a crystal ball, but it is possible. What we need to recognise as investors is the importance of being aware of these factors driving markets higher and what might happen next given awareness of these factors. Do you agree with my analysis of what's pushing stock markets higher as 2020 draws to a close? Let me know in the comments. Thank you for watching this video and for supporting this channel. Would you like to receive a short email from me in your inbox every Wednesday starting in the new year? Head along to sendfox.com/Bamford to register for midweek money. It's my weekly roundup of personal finance news and tips, and it is completely free. Sendfox.com/Bamford to sign up now. Until next time, I'm Martin Bamford, and remember, when it comes to your money, the more you know, the faster it can grow.